Going from spending money on shopping malls to investing in stocks and ETF has changed my life literally. In this video, I will talk about how I was able to drastically change my financials by shifting my perspective about money and how you can do the same in 2025. If you have never invested money in the past, you will find this video very helpful. Feel free to use the table of contents provided to see all the topics we will be covering today. If you are tired worrying about money all the time and want a real change, this video is for you. Let's get started. First things first, you will need to stop making excuses. You don't need to invest $1,000 or even $100 to get started. With the online platforms that we have today, you are able to start investing with as little as $5. And I know that you might feel like investing $5 isn't going to change lives, but it will get you started in the investing game. Once you start investing and see the dividend money coming in, there will be no stopping you. Investing will be as addictive as your morning coffee. I was in the same boat you are in right now. I always felt investing is for the richest and my $50 or $100 isn't going to get me anywhere. I couldn't be more wrong. Instead of watching that TikTok, go and start an investment account. I will tell you how you can do that in just a few minutes. In Canada, we always hear about how much the government taxes us and how almost half of our income is going to our taxes. But very few people talk about the registered accounts that the government has to offer. If you make proper use of these accounts, not only you will save on income taxes, but you will also save on the capital gains and you won't be paying any taxes on dividends. We will talk about the 3 most powerful accounts you can open in Canada. Let's start with my favorite, FHSA. Although it might look distant, if you see yourself buying a house in the next 15 years, close your eyes and open this account. Depending on how much you make, you can roughly save $3,200 on taxes this year. Here is a brief explanation on what this account is and how it works. FHSA stands for First Home Savings Account, and this is an account designed for Canadians who are looking to buy their first home. You can deposit a maximum of $8,000 every year and a maximum of $40,000 in your lifetime on this account. And the money that you put in here, it is tax deductible and you will also save on the capital gains. Let me explain. Let's say you deposit $8,000 this year. When you file your taxes for 2025 and mention your FHSA contribution, you will get an income tax deduction on this amount. If you are on a 40% tax bracket, you will get $3,200 back on your bank account after the taxes is processed. If you were not to invest in FHSA, you would get $0 back. If you successfully do this for 5 years, you will save $16,000 in taxes. The benefits don't end there. You also don't have to pay any taxes on the capital gains with this account. What I meant by this is, if your investment of $40,000 grows to a reasonable $45,000 in the 5 years' time, you won't be paying taxes on the $5,000 growth either. It is a win-win situation with this account. Next up, let's talk TFSA. TFSA stands for Tax-Free Savings Account. With this account, any growth on your investment isn't taxed. Let's say you invest $7,000 to this account in 2025 and your investment grows to a respectable $7,500. You won't have to pay any taxes on this. Right now, with small investments, it might not sound like much. But once your investment grows to a large amount, let's say $70,000, not paying taxes on a $5,000 capital gains will be a big deal. Your TFSA contribution room opens when you are 18 years old, and regardless of whether you have opened the account or not, your contribution room would be increasing in size each year. The annual contribution limit changes each year, and for 2025, the limit is $7,000. You can see the historical contribution amount in the chart here. Let's say you are 30 years now. You would have been eligible to open TFSA in 2014, and your cumulative contribution room in 2025 is $76,500. If you open your TFSA account and start investing, you won't be paying any taxes on the gains on your investment for a very long time. And even better, the contribution limit has been historically been increasing each year. Finally, let's talk RRSP. RRSP stands for Registered Retired Savings Account. This is an account designed to help save money now so that you can use it during your retirement. And just as it was the case with FHSA, the money that you contribute to RRSP, it is income tax deductible. Depending on how much you deposit in RRSP in a particular year, you can have your income tax deducted significantly. You will only pay taxes when you withdraw the money during retirement. This is good because you most likely will be in a lower tax bracket as you won't be working anymore after retirement. And how much you can contribute to this account depends on how much you made in previous year. Each year you are able to deposit a maximum of 18% of your annual income to your RRSP account. If you log into your CRA account, you should be able to see your total investment room. Now that we know about FHSA, TFSA and RRSP, you might be confused on what account should you open first. If you are planning to buy a house in the next 15 years, I would first open the FHSA account and max it out. After that, I would focus on maxing out my TFSA account. Finally, I would work on maxing out my RRSP account. If you have no plans on buying your own house, I would skip the FHSA and would start with TFSA followed by RRSP. The reason why I consider FHSA to be the best registered account to work with is because it combines the best features of both TFSA and RRSP. So try and max it out first. Now that you know what each of the registered accounts do, let's talk about how and where you can open the FHSA, TFSA and RRSP accounts. Luckily, almost all Canadian banks offer these registered accounts. You can go into any bank and ask them about the registered account. They will come back with different investment options they have to offer. Likely, the bank will also talk about different GICs they have created for the customers. I personally have tried GICs from the banks in the past and they weren't the best performing. As such, I have now gone with the investment platform route. Wealthsimple and Questrade are the leading online investment platform and I recommend opening an account with either one of them. For someone who is just starting out and wants to start investing small amounts, I would recommend Wealthsimple. They have zero commission when you buy stocks and ETFs and you can start investing as little as $1. Plus, it is free to open registered account in Wealthsimple. I will leave my affiliate link down below. Next, I want to talk about the risk of investing money in the stocks and ETF market. I don't want to be that financial guru who promises on doubling your money in a short time. There are some risks to investing money and you should not blindly follow any influencer and invest money without a bit of research. In fact, I want to clearly state that I am not a financial advisor and you should not take anything I say in this video as a financial advice. Always do your own research before investing. There are chances that your investment might go down in value. Your investment of $8,000 today can go to $7,500 or maybe even lower. But that doesn't mean you shouldn't invest. If you invest for a long time, the likelihood of your investment growing higher is over 90%. And I would take this over leaving the money in the bank earning less than 1% interest and losing over inflation. If you just look at VOO, which is a S&P 500 ETF, if you look at 1 month graph, you will see that you are actually losing money when you are investing in the stock. But if you zoom out and look at the larger time frame, you will see that you are making quite a bit in returns. Invest for long term and don't withdraw your money as soon as you see you're losing money. Hold it for a year or longer and you will almost certainly see your money grow. Finally, I want to emphasize on why you should start investing in 2025 and if possible, right away. In investing, the more months and years you are in the market, the more money you make. I want to give you a simple example of compound interest. Let's say you start today at the age of 25 and put in $250 a month every month. At the age of 60, you will have over $550,000 in your bank account. And the interesting thing is, you would have just invested $104,000 into this account. Everything else is just compound interest that you would have earned from your investments. The earlier you start, the quicker you will make mistakes and the faster you will learn. So if you haven't ever invested your money, 2025 is the year for you. If you found this video helpful, I would really appreciate if you could subscribe. We are trying to reach the 500 subscriber mark by the end of March this year. Thank you.